speech. Governor Kazimir, please.
Good afternoon. Good afternoon, ladies and gentlemen. After delicious lunch, it's a real pleasure to be back in Tokyo. Belated thanks to Governor Ueda and the Bank of Japan for inviting me, for having me here. And it's even a greater pleasure to introduce someone I have the good fortune of knowing for a couple of years now, Professor Athanasios Orphanides. So this is the second time I've had the honor of introducing Athanasios here in Tokyo, and I've either done a good job with my heap of praise the first time around, and now he wants more of it, or I have done a very bad job, and this is now my chance to improve it. Either way, I'm grateful for the opportunity. Athanasios is one of the most respected voices in monetary policy. His work has shaped how we think about central banking, especially in terms of strategy, communication, and staying calm during crisis. Today, he will focus on one of the most critical questions in monetary policy making. How can central banks design strategies that maintain credibility, improve outcomes, and strengthen transparency? And his answer is, keep it simple, but not simplistic. He argues that well-crafted, rule-based frameworks can help central banks stay grounded. And these rules offer structure in uncertain times, discipline in the face of pressure, and clarity when communicating with markets and with the public. He draws on the Fed's experience, particularly in struggles with forward guidance after the pandemic, as inflation surged and the Fed's outcome-based promises delayed action, worsening distortions. Athanasios believes that a simple, systematic rule, one the Fed had been tracking since 2004, could have helped avoid this trap. Well, his focus is on the Fed, but the lessons apply far more broadly. So let's take the ECB, for example. We have taken a slightly different approach, different route, so-called hybrid approach. We use a three-part reaction function that balances structure with flexibility. And it's not straitjacket, but it's not also just improvisation either. So from my seat on the ECB Governing Council, I see three big advantages to this approach. Firstly, it helps us deal with uncertainty, because forecasts could be hazy, models can mislead, and sometimes the economy just doesn't read the memo. A structured framework that evaluates data as they come in, looks forward, and keeps us focused on relevant indicators has been crucial on our way out from the pandemic and an energy crisis in Europe. Secondly, it helps us make much better decisions. I believe Athanasios has long warned about the dangers of too much discretion. To me, that would be about making unexpected decisions. Might bring short-term benefits, but they often lead to more uncertainty later. But there's a danger lurking at the other extreme too. Tying our hands too tightly with forward guidance is a perfect example, and I must say, believe me, that we do have a very bloody experience in Europe with that. At the ECB, timely, although some might say somewhat belated, switch to our reaction function was really important. Since mid-2022, it has provided us with a much-needed balance. Flexibility, yes, but always within a clear, transparent framework, so that we have predictability too. As my dear colleague and friend Klaas Knot likes to say, we needed a steady hand. Thirdly, it helps us communicate better. Let's face it, monetary policy isn't always the most thrilling topic at dinner parties, but it matters. And how we explain it matters even more. Athanasios believes that simple rules help make our decisions more understandable. And the ECB's reaction function does just that, or we do our best, at least. It conveys how we respond to new data, even if we cannot predict even more. We also know that trust is very fragile. In today's polarized world, central banks must work harder to explain what we do and why. Research shows that political views can shape how people see us, and that's why we focus on clear language, accessible formats, and consistent messaging. So, yeah, central banking is about inflation, but we succeed through credibility, through trust and independence, and that's where Athanasios and I see eye to eye. He's a strong advocate for simpler rules, not because they solve everything, but because they help us stay anchored when the waters get rough. And it gives us the structure we need and the flexibility we cannot do without. And it's not perfect, but it's honest, it's transparent, and built to adapt, and it has served us well. And this concludes my warm-up session, and I am delighted to welcome a colleague I deeply respect, and someone who always gave us plenty to think about. Please join me in welcoming Professor Athanasios Orphanides. Please.
Thank you, Peter. What a wonderful presentation. I will now try to give you, it's not going to be as nice, but it's going to fill in the gaps to what Peter did not have yet. But first, I need to thank the Governor and the Bank of Japan for inviting me back to this august conference. It's an honor to be here, and I really appreciate the opportunity to talk about challenges for monetary policy and its communications. Now, post-pandemic surge in inflation around the world revealed underappreciated challenges with the monetary policy and communication pursued by a number of central banks. We had discussed this 2 years ago, 3 years ago, and last year. The Bank of Japan is one of the few central banks that did not experience the grave difficulties that the ECB, the Fed, the Bank of England, and many other central banks had experienced with high inflation. And episodes of high inflation are, of course, unwelcome, but they also present opportunities to learn, to see how can monetary policy strategy become more resilient. How can the framework be applied and improved going forward? Now, I'm going to focus just on the United States today and the Fed, but before I do that, I will have a plea. I could do the same thing for the ECB. Could you please consider the Governing Council of the ECB to publish with a 5-year lag the briefing material of the decisions, the same way that the Federal Reserve is doing it, because then that would allow everybody to do an honest research that would help the ECB and Governing Council improve its policy going forward. So, with that consideration, I will focus on the Federal Reserve, where I really do appreciate the transparency of providing this detailed information about its future. So what my plan is to discuss what happened with the policy means in the pandemic, and then examine how could policy be improved framework by giving greater attention to simple policy rules. Now, what I want to do is focus not. This is the inflation spike that you see here is very similar in some respects to the 1970s. By the way, there's no need to elaborate this, but I will make the point. I give credit to central banks around the world for recognizing much earlier than the earlier experience of high inflation that there was a problem, and taking forceful action to bring it under control. The Fed, the ECB, and most other central banks that experience high inflation actually went in this way. But what I want to do is focus on two interrelated challenges for monetary policy and its communications that I don't think receive enough attention. One challenge is what I'm going to call, you're going to see, I'm really bringing this from Hayek's Nobel address from 50 years ago, the pretense of knowledge. Too much of policy is done implicitly assuming much more knowledge about what we can possibly know about the economy and the underlying data. And the second issue that is interrelated is the proclivity for discretion. And Peter already described the case of the ECB, how the Governing Council is trying to strike a balance between flexibility and being systematic, and it can be debated if the solution adopted is at the right level. Overall, when I examine monetary policy around the world, my conclusion is that we still are in a situation where we have excessive discretion, despite the recognition that systematic policy and rules are valuable. And what I want to convince you of with an example is that simple policy rules can indeed improve policy for a number of reasons. They can protect against imperfect knowledge by focusing on designing simple rules that are more robust than others. They can discipline discretion and promote systematic policy. And here I want to stress the aspect of communicating in real time the simple rules, which the communication serves as a constraint on the deviation that would constitute discretion. And the third point I want to remind you of is that by communicating a simple rule, a central bank can facilitate coherent policy communication that can be very difficult with other forms of forward guidance that try to tell you something about where the nominal interest rate is going to be 1 year or 2 years or 3 years from now, without explicitly linking that to the evolution of the outlook. So this is my plan. Oops, let me see here. So the motivation for the pretense of knowledge goes back to 1974. The previous very ugly inflation episode we had, where we know what happened, and the intellectual environment at the time, policy goals were overambitious. Central banks, for a while, they were trying to do what in retrospect appears to be too much fine-tuning. At the Federal Reserve, this was when research first started showing up with optimal control methods, with policy researchers trying to do good, but it led to bad outcomes at the end of the day. And part of the problem, in my view, was very nicely highlighted in this quote by Hayek. It seems to me that this failure of the economists to guide policy more successfully is closely connected with their propensity to imitate as closely as possible the procedures of the brilliantly successful physical sciences, an attempt which in our field may lead to outright error. Of course, we all recognize this by the 1970s, and this got much, much worse later on. The study of economics became almost like the study of mathematics, with excessive emphasis on mathematical methods. And I have to say insufficient attention to the human factor that determines decisions, and which is the element that makes us so different in economics from the physical sciences. We are still not able to model in any reasonable way how people form expectations, how they respond to events, how they respond to communication around them. We are very imperfect in that dimension, and trying to build models like in the physical sciences, ignoring that uncertainty can be quite problematic. So what Hayek admitted he preferred at the time is true but imperfect knowledge, even if it leaves much indeterminate and unpredictable, to the pretense of exact knowledge that is likely to be forced. This is going to be the starting point now to say, well, how does this pretense of knowledge and proclivity for discretion influence policy more recently with the post-pandemic inflation surge? Now, here's a short summary of policy in the United States. Of course, the policy response at the beginning of the pandemic, 1920, was fantastic in my view at the Fed and other central banks. Massive policy easing in order to help the economy from experiencing worse outcomes, but without sufficient planning for the exit strategy. And what we saw later on is that post-pandemic recovery was unexpectedly strong. Together with supply shocks, we ended up having a spike in inflation. And this is where discretion kicked in. Rather than adjust policy as one would have expected when inflation started shooting up, the Fed relied more on discretion to keep the Fed funds rate at zero for too long. And I think in retrospect, everybody can agree that it was kept at zero too long. This is one of the things that we want to study. You know, what is it that led to this problem, and how could this be improved going forward? Let me actually show you another version of this picture. So this picture shows the nominal policy rate in blue, the two-year inflation swap rate to show the underlying trend in inflation, and really a reflection of inflation expectations in financial markets, and the two-year OIS rate, the two-year horizon implicit expectation of the Fed funds rate. These are the nominal concepts on which policy focuses on. But what really matters for the economy are the real counterparts. So we can use those concepts to create a real-time two-year interest rate in the red line. And you can see here how the problem developed. As the Fed kept the interest rate at zero, and communication that did not really adjust, the two-year OIS stayed quite low as well, while inflation and inflation expectations were rising. And we ended up in an environment with really exceptionally negative real interest rates that, again, the picture I'm showing you here is a real-time indication, should have raised alarms about the stance of monetary policy. So this is the question. We can put this real interest rate in historical perspective. This picture goes back 1968, uses the three-quarter ahead deflator inflation data to create a proxy for the real interest rate. It's just a proxy. We don't have enough data to create a true ex-ante real interest rate going back. But just from this proxy, you can see that the real interest rate got to levels that were historically low. Actually, the lowest point here is in 22 quarter one from 1968. So the question is why the Fed's policy strategy allowed this error to occur, and whether simple policy rules and greater attention to simple policy rules could have helped avoid an error like this. And I list here a number of famous researchers in economics, and for almost all, I know that they participated in earlier editions of this conference over the years. It's not a new idea. Guidance from simple policy rules can help improve policy. The latest example, I will recall those who participated at the conference last year, was John Taylor's Mayakawa lecture just a year ago at this conference. We have this theme, this plea to central banks to paying greater attention to guidance from simple policy rules in order to improve policy going forward. So in light of my focus on Fed policy, I would note that research staff at the Federal Reserve over decades has contributed importantly to this research. I recall a few decades ago, John Williams was an active researcher who's with us here, active researcher in this literature. This actually goes back. I will just give you one example from the Federal Reserve Bank of New York, 1935. This is Carl Snyder, at the time the chief statistician of the New York Fed, and right at the time when in the Federal Reserve System there was a great effort to collect data, create a series on monetary aggregates, create a series on prices, create a series on economic activity. Carl Snyder realized that something like a simple K% rule, and to be precise, something like expanding currency and credit at a 4% rate per year would stabilize real economic activity best, based on the correlations he could have here. He could see from the data. And of course, this is familiar to us in the form of the K% rule that Milton Friedman favored later on. Now we know that this was policy rules based on monetary aggregates could actually have been extremely useful in the past, much less so in recent decades. In most economies, the instability in money velocity has shifted attention, and virtually everybody in advanced economies right now is looking at policy in terms of interest rate instruments. And of course, we can develop simple interest rate rules to address this situation. One of the difficulties is that with a nominal interest rate as an instrument, nothing as simple as a K% rule on money growth works. It's a nominal interest rate. You cannot say, let the nominal interest rate fixed at this level, unlike the monetary growth rule, where you can actually start from that benchmark. We first need to convert the nominal interest rate to the real interest rate. We always need to take account of how the inflation outlook evolves in examining this. But we do have a lot of research in past decades that has developed some desirable characteristics of simple rules. I think there is a consensus in the literature that simple rules are useful if they preserve price stability over time in line with a central bank's target. There is consensus that simple policy rules can be somewhat counter-cyclical, tempering business cycles. There is an effort to try to identify simple rules that are more robust to various aspects of imperfect knowledge. And an area where there isn't as much of a consensus yet, this is still under debate, is how forward-looking should the inputs to a policy rule be? And here we know some of the answers, that it's not useful for policy to be based on just past outcomes. that's just not incorporating information about the immediate outlook that you want policy to respond to. And we do have wonderful research. Again, a paper by John Williams, Andy Levin, and Volker Wieland comes to mind, that policy that is based on forecasts that are too long, like a year and beyond, is incredibly dangerous, because that sort of policy will depend on models that may be misspecified. So we need to find the right spot on the horizon, something in between these considerations. What I'm going to do is I'm going to show you an example of an actual growth targeting rule that is about as simple as can be designed. Consider deviations of nominal income growth in coming quarters from normal growth. And in my view, to benefit from the current analysis that central bank staff can do very well, is useful to be relying on forecasts. My preference is to go 3 quarters ahead, year over year. I would not object if someone tells me go 2 quarters ahead, year over year. This is what needs to be examined. And then nominal income targeting has been proposed for a very, very long time. I think one of the things that we need to be careful with is to design approaches like this that are consistent with a constant inflation target. And this can be done by defining the natural growth of nominal income to be the inflation target plus the estimate of potential GDP. So I'm going to show you examples from this rule from the Federal Reserve. But before I show you exactly a rule based on nominal income that could be based on projections from the several professional forecasters, we have enough data from 1992 to do this until today. Just look at nominal income projections, compare them to an estimate of potential output. Before I do that, I will actually show you a couple of restatements of this policy rule that we can rely on inputs from the Federal Reserve. So one restatement is what appears in blue books and later teal books. There is a rule that has been called the first difference rule in the Federal Reserve. It's now available on the Fed's website until 2019. And this suggests that the quarterly change of the Fed funds rate should respond to the projection of inflation from 2% and the 4-quarter difference of the output gap 3 quarters hence to -1 quarter. This effectively is a restatement of the natural growth targeting rule, but instead of using nominal income, it uses core PC inflation, which has been the concept of inflation preferred by Fed staff and the committee over time, and real GDP. And again, we have the numbers. You can go on the Fed's website, pick a number from each quarter, and that gives us the orange line. You can see that this broadly is capturing the contours of policy until 2019. I eagerly await to see if the Fed continue to publish this rule in the teal book in 2020, and ask me again next January, and I will be able to tell you if it's there. Now we would want to see similar kinds of prescriptions from policy rules for more recent years. Well, another thing we can do is we can use the projections provided by the committee in the summary of economic projections and do something similar. Now, we can only do this exactly 1 quarter every year. In the March SEP, we actually have exactly the 3-quarter ahead projections year over year, but we only have calendar years, so in the other quarters, this would not be exact. We can examine 2 versions of this rule. One version, we can use core PCE projections and GDP growth projections. The horizons match exactly. Or alternatively, we can use Okun's law and have the unemployment version of this policy rule. So what I show here at the bottom of the slide, in green and red are two alternative versions of this rule as can be constructed with the SEP. So what I show in this slide is from 2012, when we have the current form of the projections being provided until the first quarter of this year. I show in bullets and diamonds the prescriptions from this policy rule based on the median FOMC projections. And you can pick up a couple of things from this picture. First, until 2019, the prescriptions from this version of the rule that depends on the SEP are not that different from the staff projection of the first difference rule. You can also see the problem in the last in 2021 and 2022 when there was this massive deviation. And this is an example of how guidance from this rule could have been helpful. Now, to complete the picture, in this chart, I add the nominal income growth targeting rule from using the SPF projections. And again, you can see, as you would expect from what I've already shown you, this simple rule pretty much captures the contours of policy overall from throughout the period. And there is this one massive deviation that occurred right after the pandemic. And this is a period where one wonders, would policy calibration have been different if more attention was given to this specific rule? Now, just a couple more pieces of information. This is incredibly simple to run. All you want to do in central banking, I think the focus should be on maintaining stability. And one way to describe stability in macroeconomics is to say, what is your expectation about normal nominal income growth going forward? This is what I show here as nominal GDP, the natural growth of income in the dashed line. And if you see that the projection is moving very far away from that, you should respond. And the direction of the response is pretty simple. If nominal income is growing too fast, tighten a bit. If nominal income is growing too slowly, ease a bit. This is not complicated. This is just this is a description going back 1992, just to confirm, without imposing the zero lower bound constraint, that this policy rule is pretty good in capturing the contours of policy. With one example, the post-pandemic inflation once again. If you check the detail here, you are going to see the Fed ended up responding faster once they started raising rates to this policy rule. You can also see, if you use the several professional forecasters' projections, well, according to that survey, the economy is still pretty hot in the projection. So according to this rule, if anything, there will be a slight bias towards tightening, but not really enough to be concerned that policy is calibrated very differently from what we would want to have. So let me conclude by returning to the theme. We have seen two interrelated challenges for monetary policy and communication, and what we observe is that the inflationary experience of the recent past suggests that we have not yet overcome this problem. We still see a proclivity for discretion. We still see a problem with the pretense of knowledge. And my simple point is that monetary policy can improve with guidance from simple policy rules. I'm going to end with this slide and a few remarks, and I want to highlight that, following up what Agustin told us this morning, a benchmark rule can build trust in the central bank. And it can also protect against major policy mistakes. A benchmark rule can promote systematic policy. Now, this is not to deny that no rule can fit all circumstances. This is the point of how do you use discretion. Discretion, in my view, should be used on top of a benchmark rule, not in the abstract and without communicating what the benchmark is. This is what Agustin described in the morning session, a situation where there are circumstances when the central bank can communicate the reasons why something exceptional needs to be done, why discretion should be used, not as a rule, because something is different. Publishing a rule in real time disciplines the use of discretion and improves the central bank's communication under those circumstances. So ultimately, the message is quite simple. Adopting and communicating benchmark policy rule can improve monetary policy. Thank you.
So, thank you very much. Thank you for presentation. That's once more we have understood that we are far from being perfect. I think definitely we do expect a lot of questions from the audience, but I would like to start with a question, because you have made a strong case for simpler rule-based framework, but our world is really crazy, so we do live with pandemics, with a lot of energy crises, wars, and all these things. So how do we ensure these rules remain relevant without becoming rigid or outdated? The question is, should we revise periodically these rules, or should we incorporate some waivers or escape clauses into that?
So thank you for the opportunity to answer two questions actually related to this. Does this thing work now? Okay, so thank you for the opportunity. So the first element is how do we think about discretion? And in my view, one of the best expositions of how to be systematic, rules-guided, and use discretion is John Taylor's original paper at the 1992 Carnegie Rochester conference. A rule can guide you most of the time, and you can always then ask the question, are we facing a crisis? Are we facing something exceptional? If you are, then of course you should deviate from the rule. But the fact that you have communicated the rule makes it much easier for the central bank to explain why it's deviating, and also communicating that this is an exceptional period and everybody can expect that policy will continue to be systematic going forward. So it's an advantage to communicate a benchmark rule, even anticipating that you would want to deviate from it in order to handle unforeseen circumstances. Now, the second element of your question is something that hasn't really been analyzed in research purposes as much, but I find incredibly useful as well. No single rule can be everlasting and unchanged. So indeed, as I noted in my conclusion, one needs to foresee that a benchmark policy rule should be re-examined in regular intervals, should be reevaluated, should take into account advances in knowledge, advances in our understanding of the economy. So I would expect that if a central bank adopts the recommendation of publishing a simple policy rule, I would expect that there would be an evaluation process. Internally, it would be going on all the time. Externally, I would expect every few years the policy board to say, well, you know what? After examination, we decided that we need to adapt the simple rule that is guiding us in this way. So adaptation should be part of the process. I would much prefer that policy boards spend more time on discussing the nature of systematic policy rather than discretionary policy and decision from meeting to meeting. So it's a matter of rethinking how the policy should be organized and communicated.
Okay, so we can start with the question. Maybe, I'm so sorry, I forgot my glasses, so it will be terrible for me, you know, so now to, okay, please, go on, please.
Bank of Japan, Nakamura. Thank you, Athanasios. Very insightful discussions. In your paper in the past, you discussed the difficulty of the real-time assessment of the economy, right? And this real-time assessment issue is pretty critical for the using the any reaction functions or policy statement. Particularly the GDP numbers are revised so frequently and by large margins. And also the if we use the natural rate as a guidance for the Taylor rule, also the estimated natural rate has a huge margin of errors. So how do you come up with this real-time issue with the simple rule?
So in the design of a simple policy rule, one should take into account these sources of uncertainty very seriously. And as a matter of fact, this real-time uncertainty is what, in my mind, should be convincing enough for central banks to move away from policy frameworks and simple policy rules that stress concepts such as the natural rate of interest, the natural rate of unemployment, these level concepts that can mislead us tremendously. The example policy rule I highlighted does have one concept in it that is similar to that, the potential output growth. We are also uncertain about that, but as a practical matter, the uncertainty about growth rates and the uncertainty about potential output growth is an order of magnitude smaller than the uncertainty associated with levels like the unemployment gap or the output gap or the interest rate gap. So there is no perfect metric, and this is what you pointed out. The question is, for your economy, once you evaluate using historical data what you are more certain about and what you are least certain about, what becomes a simple policy rule to use. Now, you also noted real-time GDP is revised. You could also add to that forecasts are uncertain. Of course, we live in an uncertain world. The point is to design a policy rule that will reduce the probability of serious error, taking into account the fact that everything we use will be subject to some error. And this is where the policy research can be very useful. Again, the example I've shown you has the property that it focuses on things whether we are relatively more certain about based on my experience of advanced economies, without saying that, that it eliminates uncertainty. It does not eliminate uncertainty.
Thank you. Daniel, please. Go on, please.
Thanks. So Athanasios, you focused very much on the 21-22 episode. Now, I don't know the exact numbers, but my recollection at that time is the Fed expected still quite a large output gap and was forecasting inflation still probably below 2%. Now, I understand why you sort of argue you shouldn't use these variables in your simple policy rule, but it's still the fact that they were communicating this is how they expected the economy to evolve. So how would you balance, on the one hand, you're forecasting a output gap and inflation below target, and then you say, we'll also communicate this simple policy rule that says interest rates should be much higher. Do you suggest not communicating the forecasts, or how would you balance these two aspects of the communication?
Yeah, so a number of aspects to this. So first of all, so the simple rule I highlighted does not rely on the level of the output gap at all. I think this has been particularly problematic over history. Central banks that do use policy rules that have the output gap are advised to have a really, really negligible or very small sign on this. Now, with respect to forecasts, mean, one of the ways to characterize the problem in 2021 in many economies is that inflation forecasts ended up being overly optimistic. But what are those forecasts? Those are longer-term forecasts. Those are forecasts of inflation 1, 2, 3 years out, which, in my view, and based on some research that we have seen over the years, is not the horizon you should be focusing on to adjust policy. What I find most useful in central banks' real-time analysis is that the stuff usually is very good in telling you where the economy is now, current data, and a couple of quarters out. So that's kind of not quite data, but that's not a model-based forecast. And this is what policy should be based on. It's not robust to be guided by forecasts that are 1, 2, 3, 4 years out. This actually can relate to another discussion of how we think about the implementation of inflation targeting frameworks, and we can have that discussion as well.
Ian, please.
Thank you. This was a great keynote. 2 questions. The first one, when I look at that figure you showed, the Fed did not follow this rule, but you know, it ended up basically it was like following the rule, except one observation. I thought that was a pretty good outcome without having a very clear rule. The second question, how should I think about these very simple rules in an environment, you know, you have these global shocks affecting these economies more prominently? Or, you know, think about, and you know it very well, for small economies, these shocks are even more important. How should those rules be designed?
Christoph, please, also from IMF.
Oh, thanks. Really very interesting keynote. So you've focused a lot on the potential for monetary policy rules to limit what you call the proclivity for discretion. But central banks, of course, have really used balance sheet policies quite extensively in the last 15 years. And so I was wondering about your recommendations about how to limit discretion with respect to, say, QE and other balance sheet policies. Thanks.
Sure, thank you. So with respect to, let's say, small open economies, the idea is to develop a benchmark that is a suitable, robust benchmark for any economy that you are facing. And if you are in an environment where you believe that you have a greater variance of supply shock, that doesn't change the basic laws of economics. It does not change the fact that if your projection for inflation goes up, you should be adjusting policy upwards. Now, you don't need to follow any specific pre-announced rules to adopt policy based on good principles. I think when I evaluate the Fed over the past 30 years, most of the time, Fed policy was reasonable. But it does help to be clear and publish a policy rule, because that is exactly what would constrain the inappropriate use of discretion. So in my view, one episode of 2 years of policy that appears to be badly calibrated is one episode too many. This could have been avoided. Now, with respect to other measures, yes, with unconventional measures, one would have to go through the thought experiment and say, if the simple benchmark rule would have wanted me to ease policy by X, how do I implement that? And my thinking about how many central banks have been implementing unconventional measures like quantitative easing is to try to identify what is the equivalent exchange rate policy or the equivalent balance sheet policy that would deliver the same degree of accommodation. Now, in my preference, it would be better to do that with a simple rule as well, but that would require additional research. Reading through the transcripts of the FOMC from the early, after the global financial crisis, it's evident that the FOMC had considered whether they could be more systematic, but I can see that at the time, there wasn't enough historical information to formulate a balance sheet rule. frankly, I think that by the pandemic, there was enough information to formulate a balance sheet rule if you wanted to go in that direction. And going forward, I can actually see some merits to being more systematic with balance sheet policy as well. The message is pretty simple. Don't let discretion totally out of hand. Announce a benchmark rule that is considered appropriate as a first step in the policy advice, and then force the bank to explain its deviations from that. That does not eliminate discretion, it constrains discretion. And constraining discretion is one of the ways we can even describe the inflation targeting framework if you want to be thinking it in those terms. Thank you.
And now I think time is over, so that's it. Thank you very much, and for your thoughts, for your recommendations. Hopefully we'll follow it. Thank you very much.